From the newsroom of Impact Alpha, I'm Brian Walsh, and this is your Impact Briefing for Friday, April 22nd. Happy Earth Day to all who celebrate. Today, I'm joined by our roundtable regulars to discuss old-school activist investor Carl Icahn emerging as a new-school activist ESG investor. Imogen Rose-Smith is an Impact Alpha contributing editor. Hi, Imogen.
Hi, Brian. Happy Earth Day.
Thank you. And David Bank is Impact Alpha's editor and CEO. Hi, David.
Hey, Brian, and hey, Imogen. And we'll have some cuts from this week's Agents of Impact's call on climate adaptation financing.
Looking forward to that. But first, here's what you need to know from This Week in Impact Investing. This week, Impact Alpha featured a pair of guest posts about two efforts in Mexico that engage indigenous peoples in land restoration, or should we say earth restoration, along with shared prosperity. One example is Ejido Verde, which is planting regenerative pine resin trees on a 25-year plan to reforest degraded landscapes. A century ago, black farmers in the U.S. represented 14% of all farmers. Today, it's just 1.4%. So in New York State, the community-led Black Farmer Fund aims to shape the state's food system by providing flexible capital for black farmers and black food entrepreneurs so they can set their own financing terms. VC Include is seeding 10 emerging climate fund managers. Through their climate justice initiative, Taj Eldridge and Bahia Robinson are distributing $100,000 grants to 10 diverse managers who are tapping talent and solutions in black and brown communities. Among the recipients are Supply Change Capital, 22 Fund, and Home Team Ventures. Noted tech investor Chris Sacca recently wrote that, quote, "There's never been a better time to start a carbon removal company." Case in point, Sacca's own Lower Carbon Capital raised a $350 million fund for carbon capture. Investors include the payments company Stripe, which last week announced a $1 billion frontier collaboration to finance carbon removal. And finally, Impact Alpha's Rudy Sonatas brought us the story of Pursuit, a new social enterprise upskilling low-income New Yorkers for high-paying coding jobs at companies like Twitter, Uber, and Microsoft. Through an income share agreement, graduates repay Pursuit when they start making over $60,000 per year. Pursuit graduates have seen their income increase from an average of just $18,000 per year to $85,000. Now it's time to get our roundtable regulars back together for our featured conversation. I'm joined once again by Imogen and David, and we've got a lot to chew on. Let's start with activist investors, which is a term that applies to two types of investors. Historically, an activist investor was also known as a corporate raider. The typical image here is a swashbuckling Wall Street heavyweight who purchased a stake in a public company in order to influence how it's run, with an eye towards maximizing financial returns for themselves and other shareholders, no matter the cost. More recently, the term also applies to those investors who work to improve the ESG performance of listed companies. In Carl Icahn, we now have an example of an old-school activist engaging in new-school ESG activism. David, why is Carl Icahn back in the news, and why does it involve ESG?
Well, Brian, the ESG and impact world was abuzz this week with a letter that Carl Icahn sent to the board of McDonald's. It's this part of this board fight that he's waging around animal welfare. But what was more sort of quotable, I would guess, was the sort of broad swing he took at ESG generally. He said, "I want to shine a light on what may be the biggest hypocrisy of our time. A large number of Wall Street firms and their bankers and lawyers appear to be capitalizing on ESG to drive profits without doing nearly enough to support tangible societal progress." And he accused them of a cover-up, that they were downplaying their ESG-related economic incentives in order to promote their purported social impact. It was kind of a broad takedown of what's become kind of the ESG industrial complex on Wall Street, and he was taking on asset managers who are not fulfilling their fiduciary responsibilities, all as part of this campaign against McDonald's, as I say. And if you read between the lines, or not so much between the lines, it becomes clear that he's really pursuing one specific ESG plank, I suppose, around animal welfare and around pigs, gestating pigs, and whether they're kept in crates or not, as in part of McDonald's supply chain.
So Imogen, now you've covered institutional investors and Carl Icahn for many years. Can you walk us through what he's up to and why is he engaging with McDonald's now?
So I love this idea of Carl Icahn as a warrior for like social issues, right? This notion that somehow like, Wall Street is evil and conniving over ESG, and Carl Icahn's just there fighting the good fight for the pigs is amazing. And if the first line of his letter is fantastic. It says, at this point in my career, I consider it my responsibility to engage in constructive activism to help rectify glaring injustices perpetuated by many ineffective boards of directors and management teams leading America's top public corporations, et cetera, et cetera, et cetera, et cetera.
Yeah, it sounds like a call to action for all, right-thinking finance professionals to step up to the plate, no?
Well, and then he goes on to say that, the glaring miss in all of this ESG blah, 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 that, finance firms have been talking about over the last few years is that none of them care enough about, like, animals and animal welfare, which, is going to come as a shock to Fair and Jeremy Collar and all the work those guys have been doing for the last 10 years. To take the step back, Carl Icahn, as many people know, is the sort of legendary corporate raider who, started out as a trader, made his name during the sort of heydays of the leverage buyout, Michael Milken era, doing leverage buyouts. He was sort of notorious for like getting on the phone and yelling at executives. TWA was his best known buyout when he bought the airline and then basically drove it into the ground. He was also involved in RJ Nabisco, which was again sort of searing example of sort of corporate greed during the 80s and the height of this sort of barbarians at the gate era, and was itself, a tobacco company, demonstrating that, nobody cared at the time about, things like tobacco. And so Icahn sort of stood out for his willingness to kind of be aggressive. He was sort of, as I say, famous for getting on the phone and yelling at corporate executives. It was like a bad day if Carl Icahn was like amassing a shareholder position in your company. And he's sort of notoriously cheap, which also makes it hilarious because he's actually only bought like something like 200 shares in McDonald's.
So 200 shares, that represents what, about a $50,000 or so stake at the current stock value. So not the type of stake you might make if you were actually looking to do a more of a takeover or more serious engagement. Is that fair?
Exactly. He's just owning the shares to be able to make his point, at the annual meeting.
And here we are, and others reporting them.
Yeah, exactly. So it works, right? So again, he was very well known in the sort of the greed is good era of leverage buyouts. So, and part of the leverage buyout playbook was like laying people off and getting rid of pension plans, that defined benefit pension plans and stuff like that. So there's a lot of social criticism about what these kind of investors were doing, and a lot of criticism that investors like Icahn, both on the hedge fund side and the private equity side, were really just in it for the short-term financial gains that they could make rather than the long-term health and prosperity of companies, which is the complete opposite argument from a sort of an ESG argument. Now, Carl Icahn would probably say that he's always been on the side of shareholders and he's always been on the side of, attacking bad governance, and that like this is just what Carl Icahn does. So what's different this time around is that he is cloaking his campaign not in a discussion of profitability. In fact, he doesn't really care about profitability. He's concerned about the pigs. He's concerned about the pigs and he's concerned about animal welfare, and that's it.
Can I just pick up on that for a second, Imogen? Because what you said is really interesting. He's doing this at McDonald's, not on the basis of an economic argument from McDonald's, just like Elon Musk at Twitter is not actually making an economic argument over there. And so you've got a set of well-heeled, investors now making essentially social arguments for corporate.
That's what I think is so interesting, is the pendulum has kind of swung and done a complete 180. That there was, again, going back to the 70s and earlier, there was a form of sort of social shareholder activism, which was basically, a bunch of well-meaning hippies filing letters with the SEC trying to get corporations to do stuff like, stop producing napalm and stuff like that, right? That's the sort of social responsible investor community that evolved really out of the activism, the anti-apartheid South Africa activism movement. So those types of investors have been around for a really, really long time, but they kind of got swatted away because they never really had they never had much of a stake in the businesses. They never had much power, and they were making largely social and later on environmental arguments that the whole of Wall Street didn't take seriously. Now, those types of investors, for the most part, are putting their arguments in economic terms. So the clearest one is sort of stranded asset risk of fossil fuels. And they're saying, or even on diversity, they're saying, you should do these things because it is good for business. And meanwhile, you have Carl Icahn and Elon Musk out there saying, no, we want to do this because we want to do it. It's not to do with investing. And arguably, again, it's reflective of this deeper underlying social problem we've created, where you just have a handful of people who have so much money and so much power that, Elon Musk can wake up one morning and decide to mess with Twitter for fun.
One of the things that strikes me about the McDonald's case, which is interesting, is that there's going to be a lot of shareholder resolutions at the annual general meetings coming up in the next month or so, and most of them, some of them might pass, and they'd be seen as sort of indicators of sort of sentiment, but they're all kind of advisory and non-binding. But if you actually elect board members, and I have no idea whether Carl Icahn's 2 board members that he's putting up at McDonald's will win or not, but people are moving to board fights because those actually are binding, and shareholders can elect new directors to the board and presumably change the trajectory of the company. So that's a tactical sort of nuance of this.
Well, yeah, and it speaks to the success, obviously, of Engine number 1 last year, running a campaign against Exxon and getting 3 independent board members that they elected. So yeah, no, look, but I suspect that Icahn's pissed off because Wall Street isn't taking him as seriously as he would like. And he's not wrong, by the way, that there is, a lot of hypocrisy in ESG. I'm just not sure that he can really be the standard bearer for the anti-ESG hypocrisy crowd.
Is Carl Icahn the right person to call out ESG hypocrisy?
But that's what's fascinating, is that you've now got social issues being the point of the spear of these corporate I don't know what you call them, in Elon Musk's case with Twitter, takeover battles, hostile takeover battles. We can see, hostile takeover battles waged on the front of supposed social purposes. Now you can talk about what Elon Musk's social purposes might or might not be, but just the notion at a structural level that you would try to take a company private and make a hostile takeover bid, not, as you said, on an economic basis, but on some kind of notion of a social basis.
Yeah, you couldn't do that, as a fiduciary, you couldn't do that, right? You couldn't make the argument that you just want to do this for social reasons, not economic reasons. But as an individual, as Elon Musk or Carl Icahn, with your own money, you can do whatever you want, right?
Right. It's hard to do it with OPM or other people's money. But if you're a multi-billionaire, I think Carl Icahn's net worth, Bloomberg puts at over $23 billion. Elon Musk's net worth is in the hundreds of billions of dollars. So they are able to kind of use their own capital to engage in these kind of issues in a way that typically, if an activist investor in the making of, if you will, Engine number 1, they did it with other people's money. They were able to launch their campaign by engaging a broad set of investors and getting other institutional shareholders who have a fiduciary duty on their side. So they were able to make the economic case. But here, Icahn is making in somewhat if you will, a personal case, his personal preference for this ESG issue.
He tries to make a risk mitigation, a corporate risk exposure argument about supply chains. He tries to make a climate, adaptation or climate mitigation argument about the dangers of corporate agriculture.
Isn't really in it, right? I mean, for him, it's very much about the pigs in their cages and the horrible conditions. And my understanding is that it was his daughter who drew his attention to this.
And McDonald's previous pledges, which have not apparently, according to Icahn at least, been fulfilled, which does also point up, the notion that these commitments and these pledges often get made, either under pressure or in the heat of the moment or what have you. The follow-up and the accountability for fulfilling those pledges sometimes lacking.
Yeah, the pledges make headlines. The lack of follow-up years later doesn't, unless you have someone like Carl Icahn who decides to shake things up.
Now, in the case of Musk, though, I mean, one of the things that's significant there is that while he might have hundreds of billions of dollars himself, that most of that money is not liquid. And he's made it clear that he isn't planning on putting all of the money up himself. And he plans on getting loans from somewhere. And we'll see if he really comes up with the funds. But what's again striking about Musk and Musk's popularity is so much of it is driven by retail shareholders. He very much plays to the retail crowd. Like, he doesn't care about like what Wall Street thinks. He likes talking directly to shareholders. And, I think if you remember when he was trying to take Tesla private, his idea was that shareholders would kind of go along for the ride and convert into sort of private holdings. And so, again, his sort of fan base / investor base is so retail driven that it allows him to he's not, again, relying on the sort of the plodding, boring institutional investors who have to care about things like, fiduciary duty and universal ownership. He can pitch it to the Tesla bros, and that's the natural investor base for him. And again, they don't have the same obligations in terms of how they think about the world. They can just do it because they think it's fun.
Well, and then you get to sort of a new kind of shareholder democracy, like you're saying, like it's sort of previewed in the meme stock phenomena and all kinds of other things, where you have to actually sort of almost a public referendum in some way. And you can see whether some kind of ESG responsible investing kind of pitch makes sense, whether some kind of libertarian, no censorship, don't tread on me pitch makes sense. And you might have different kind of camps of investors. That's just like we have different kind of camps in politics.
ESG has sort of lost out in the Reddit world, I think, because it's still kind of seen as pious and boring, right? And Elon Musk is, even though, again, it's batteries and it's things that are kind of ESG, the S and the G is so out of whack in terms of what he's doing that it's, he's popular among these kind of, often more libertarian groups who see shareholder investing as fun and have a dream of getting rich. That's not ESG.
Sorry, and him and his billionaire buddies have been taking to outright trashing ESG. I think he said it was the devil incarnate. I don't know whether it's Mark Andreessen or quoting Peter Thiel, who said it was like the Chinese Communist Party. I mean, there's kind of they're taking a. Carl Icahn is saying they're not living up to ESG. The companies are not living up to ESG. These other guys out in Silicon Valley are saying, screw ESG.
Yeah, and I mean, we talk about this all the time. They look at Silicon Valley and governance. They hate it, right? They want to have all the ownership and all the power and, make all the money.
I always feel obliged to point out at this point in the conversation that some of the early investors in Tesla were so-called impact funds. There was something called the Bay Area Equity Fund, which later became DBL Partners, and still have a stake in Tesla. But they were an explicit impact fund that had foundation investors under program-related investments. The whole 9 yards of the impact world were the early investors in Tesla. As an impact play.
Which kind of goes back to what I was saying, is that the world's done an entire 180, right? You now have Carl Icahn, saying he's the true ESG, and Elon Musk looking like, effectively a corporate raider.
What a tangled web we weave. I think that's a good place to leave it for now. But before we go, David, there was also an important call this week on climate adaptation. Can you talk us through some of the highlights from there?
Well, we dug in deep, and the IPCC reports earlier this year, called out the need for, adaptation. Climate change is here. The adaptation, should be well underway, but it's lagged in the financing, even as regards to climate mitigation of, actually reducing the carbon, which is also not adequate, but climate adaptation financing is really not adequate. So we decided to take a look at it, and we caught up with Jay Coe, Lightsmith Group. They've raised the first, or one of the first, private equity growth funds around climate adaptation and climate resilience. Here's what he said.
I think the commercial capital flow, the trillions of dollars we're talking about, are not going to be supplied by kind of artisanal sort of farm to table approaches. We need to scale dramatically incentives. And if the economy is coin operated, let's put coins in it and have it operate. So shifting the incentives for people to act in their best interest, to do that by looking at data, looking at analytics, looking at solutions and scaling them, I think is our best chance to shift the bulk of the economy. There are many solutions out there. The one thing I think that was said very early on was this is an enormous opportunity. So to those agents of impact that are out there, come to the adaptation climate resilience universe, start companies, scale companies, come and invest in the adaptation and climate resilience opportunity, because it is an enormous opportunity. The entire future will continue to change forever now, because climate change will continue to unfold through the end of the century. And the question is, what choices do we make? What technologies do we invest in? What investments are we scaling to address those questions? Because those questions will continue to come.
And I want to leave us with Njenga from Apollo Agriculture in Nairobi, Kenya. When we were digging into this in preparation for the call, I asked an expert how to scale up climate adaptation, and he said build 100 or 1,000 Apollo Agricultures, and they've got integrated kind of strategy to help farmers plant better seeds, get better irrigation, get better data analytics, get crop insurance, and then get financing for all of this. Turns out that he grew up on a farm. His mother still has a farm. And here's what he told us about some of the real world of getting farmers to adapt.
Yeah, for sure, David. And I can say my mom has improved in terms of her farming methods. I had to also take a different approach in terms of training her, not me going and telling her that you need to do this, you need to do this. But I had to actually have my own farm and be able to show her on how to be able to farm better, right? Because that is how farmers change their mindset. They believe by seeing and actually seeing it in practical sense.
Once again, that was Njenga from Apollo Agriculture in Kenya, and you can see him and all the speakers on the call on a video replay, and you can get to that obviously through Impact Alpha and the brief.
All right, well, that's going to do it for this week's Impact Briefing. Thank you so much to Imogen.
Thank you, Brian. Thank you, David.
And thank you to David.
It's always great to be with both of you. Thanks.
And thanks, as always, to our producer extraordinaire, Isaac Silk. For more, subscribe to get full access to Impact Alpha and the Daily Brief. Right now, we're offering podcast listeners $100 off their first year subscription. Go to impactalpha.com/subscribe and use the code BRIEFING100. I'm Brian Walsh, Head of Sustainability for the capital markets firm TP Icahn. Until next time, take good care.